In some cases, developed markets are looking positive for investing in emerging markets for long-term growth, while in local markets, bonds and listed property are mainly being supported by foreign investors. Philip Bradford joins us now from Absa, and he's going to tell us a little more about why foreigners love our bonds to this extent.
Thanks, Bronwyn. I think it's very important whenever you are putting together an investment portfolio is to start your view globally. Because at the end of the day, the South African market, the marginal investor is the foreign investor in our market. We've already spoken previously and on previous occasions about the retail stocks in South Africa and other industrial counters that are potentially overvalued. But we're consistently seeing flows into our equity market and our bond market, and those are mainly foreign flows. We're seeing 50 to 75% and more of the shareholdings of those companies now being held in foreign hands. So what you need to do is understand how their minds are working before you can understand where our markets are going to be moving. So from a global perspective,
So how do you get into the foreigners' minds? That interests me.
Well, luckily I'm part of a global investment team. So we start off looking at things globally, and we would be looking at investment portfolios from let's say a US dollar, a euro or a sterling perspective where interest rates are extremely low. So straight away you know that they're going to be looking for yield in those portfolios, because bonds and cash are not going to give their investors the returns they need over the years to come. And that's the trend we're seeing. We're seeing demand for yield both on the equity side and on the fixed income side. Earnings growth that they're not getting out of the developed markets, they're looking in the emerging markets. So you're seeing the flows come into our bond market, our property market, even short term on the cash side. So those flows are likely to dominate our local market movements for years to come until the interest rate environment normalizes in a foreign environment.
Warwick, do you appreciate these insights into foreign minds?
Yeah, I think it's very important. You know, a situation where you'd have South African bonds yielding what,
7.5.
Yeah, compare that to Spain at 7.5. I mean, wow, how does the wheel turn? I mean, you know. Asked me 10 years ago, would that conceivably ever happen? And you would have said, well, you know, what are you talking about? Are you in another planet? So it's a big change there. But what intrigues me is the issue of, well, you've got negative real returns, particularly on a short-dated bond, somewhere like the US, UK, etc. Here we're probably sitting on round about flat to round about zero. I mean, where are we compared to other emerging markets?
Yeah, if you cash-wise in South Africa, you're looking at negative real returns. So after inflation at roughly 5.5, you're actually looking at it, and after tax in particular, it's definitely a negative return. Globally, without a doubt, what you're finding now is the gap between dividend yields on global stocks, developed market stocks, and bond yields are at the highest sometimes that they've ever been in recorded history. And that is typically a good value sign. You could argue which one of those is disconnected, but you would have to look at those bond yields and say that they're unsustainable at those levels. However, though, they are likely to probably stay at those levels for quite some time. And while those rates stay low, it makes our rate environment look extremely attractive. Property is one of those sort of areas in South Africa where you may be getting 6.5% on property yields at the moment, but you're seeing that growth still consistently come through. And that is what you're not seeing typically on the developed markets. That said, though, you've got to also be cautious about chasing growth when you're investing.
But what about the question here, emerging markets versus South Africa versus other emerging markets?
Say Brazil or something.
Well, it's very interestingly, we've been favored over those stock markets in particular this year, and you've seen retail stocks, as an example, in Brazil and Russia, been sold off quite aggressively because the growth has been coming through in our earnings, particularly from our retail stocks. And you're likely to actually see that probably continue in the short term. However, though, South Africa on average is roughly, let's say, 12.5% on a price to earnings basis at the moment. That is actually overvalued relative to other emerging markets, which are below 10, sometimes 9%, 9 times price to earnings at the moment.
Doesn't that mean heed caution?
It is heed caution, but I think what we need to understand is the nature of the investor that's investing in South Africa right now is not necessarily a deep value investor. We've sat here before and spoken about Sasol and saying how attractively valued it is, but we constantly see it getting sold down because the foreign investor tends to be a more momentum-based investor. They're looking for earnings momentum. So the key to watch out for on the local market are the earnings guidances from the local retail stocks, the local industrial stocks. Look at their earnings, and as soon as they're not pulling through 15, 20% earnings growth anymore, I think those foreigners are likely to leave our market.
At the moment, though, we're pretty safe on that front because the earnings momentum is there. Would you agree with that?
Exactly right. And the earnings momentum is against the resources stocks. So as a long-term investor, you'd be happy to buy those stocks, and in 5-10 years' time, you're probably likely to make good money. But over the next 12 months, I think it's still, we've got to watch out.
I want to drill into those insights. And this, of course, is a discussion that we have often on the desk. Do you buy retail stocks, industrial stocks that have run hard at this point in the hope that 5 years down the line, they've really just gone one way, and that is further up?
Well, I think I basically agree with what Philip's saying there. I mean, there is a heck of a momentum there. It is driven by foreigners. And he's described the nature of the beast there. There's a lot of hot money there, for lack of a better description.
But if we're starting to look expensive when compared to other emerging markets, as I said, he'd caution, couldn't this reverse very, very quickly? And then you'd probably be caught on the downside of the retail stocks.
Exactly. I'd be very cautious about buying into those stocks at the moment, particularly the local retailers. But I would be quite happy to hold on to them in the medium term, because over the next 12 months, they're probably likely to be a better place than some of the resource stocks, which are continually getting cheaper. So until you see those the earnings outlook start to improve for some of those resource stocks, we still need to be cautious. That said, though, with the Aussie on a 12.5 PE, you've got industrials on 18, and you've got resources on 8. So actually, there's an interesting situation that our market is in right now. But importantly as well, there are other asset classes.
Before you go there, are resources going to continue to get cheaper, Warwick?
They could, but you know, one of the problems is that markets tend to start discounting ahead, and trying to discount them discounting can be quite a neck-snapping game, which is why, you know, you go short, for example, on the likes of a retailer, and it's on a PE of say 16. Well, it can crush you when it goes up to a PE of 20, but the day it turns, it can really get violent. So, you know, what Philip's also talking about there is value, and I mean, there's no question there are pockets of severe overvalue and undervalue on this market.
You're still ignoring my direct question on resources.
Naughty me.
Do you think they're, exactly, naughty you, do you think they're going to get cheaper?
They could, but I think buying
what
from
are
here
you
down,
doing? What play are you making with resources?
I'm picking up.
You're picking up?
Yeah.
But you're staying away, Philip?
No, definitely starting to pick up on the resources side, but with a 5-year, 10-year type outlook, not with any expectation of them turning around in the short term. It's very difficult. We all know it's almost impossible to time markets. But what you want to be cautious of, though, is I would say diving in with both feet at this point in time. I'd be looking to pick up into weakness. While you've got a crisis in Europe, while you've got China slowing down, that is feeding through to the earnings of those resource companies. And until we see guidance that's likely to turn that around, we need to be cautious.
Global financial crisis 2. Let's go all out on this segment. Do you think it's on the horizon?
Well, to some
Are
degree,
we in the midst of it?
It's already there. I mean, particularly in Europe, anyway. And it's, you know, it's whether the splash goes wider than Europe, which, to some degree, a negative growth. Yes, it might. I think Europe pretty much knows what it needs to do, but it's also in a position where they have to decide who's going to blink first. And that might take a little bit more pressure. Europe's developed the style of being pushed to the brink and then suddenly doing a whole lot all in one go. And I think we're going to see that same process roll out in Europe.
Why would we escape the negativity from Europe if we didn't escape the first time around?
I think we will never be able to escape it. We're in a global community. However, though, the difference between now and 2007 is that developed market equities are trading at nearly 2 standard deviations below their long-term or their 10 years price to earnings type multiples. So what that means is a lot of it is in the price right now. The markets are probably factoring in earnings coming off 30-40% in the developed market companies. It's not factoring in calamity, though. So if we do go into another financial crisis, we are likely to fall. However, though, a lot of it is in the price right now, which is very, very different than when the whole market is overvalued. Because at the end of the day, we're investors. We're not investing in economies, we're investing in companies. And a lot of those companies are in good shape.
Those companies in good shape, you're talking about the developed world?
Correct. The developed market is in good shape. Interestingly now, emerging markets have sold off a little bit over the last sort of 6 months or so, and they're starting to enter attractive territory again. Emerging markets on average are on a 9 PE, We're on a 12.5 PE. So that does tell you a bit of a story. But you're actually equities in general are likely to outperform other asset classes. And at the end of the day, the big money around the world is not just investing in equities. It's moving between equities, bonds, and across multiple jurisdictions as well. So what
other asset classes would you be favoring right now?
I'd be favoring, as a global investor, as a South African investor, if I'm going offshore, I would only be going into equities. As a global investor, if I'm a dollar-based investor, I'd be looking at higher yielding investments like more credit-based investments into companies, so bonds of companies, more shorter dated investments without too much duration. I'd be steering clear of developed market government bonds because the yields are just too low. So as a global investor, I'm still going to be looking for yield. I'm also going to be looking at emerging market bonds, which plays back to our story in South Africa here, why our bonds are so strong.
Philip, in terms of international bonds and equities, let's take the US as an example. I mean, in terms of the flows, are you seeing private flows into US bonds versus equities, or how's the funds actually moving?
I think as private investors, you often tend to be behind the curve because they're often following what's happening from a news perspective. So I think to get anyone to invest offshore right now is actually very difficult. If our advice is actually to go to where the trouble is, people are very reluctant to do that. So very often it's one thing having a view on something, it's another thing finding a way for people to invest in a comfortable way. So what we've done with clients, some clients are very aggressive and are happy to take on that risk equity type exposure. But we often put protection in clients' portfolios, put some sort of an optionality in place, some sort of insurance in place, so that if we do go into another financial crisis, as an example, they do still have that insurance in place.
When you talk of investing where the trouble is, what are your thoughts on the US? Are you also encouraging people to invest in the US? Do you think the US is in trouble?
I think the US market has run up quite a bit from where it was. So it's not as cheap as it was. It still is relatively cheap compared to its long-term average. And we are not at this stage seeing the trouble. We believe that the trouble that's in the price is not likely to play out. And actually the US economy is probably in better shape than a lot of people are factoring in.
So you're hopeful that the US will pull through, all that printing of money is working?
Well, they're not going to come out of it in fantastic shape, but I think the markets are factoring in a worse scenario in the American economy that is actually playing out. You can see it on their home sales, you can see it just on the activity. Obviously the data is mixed and it comes out all the time, but on average the American economy is probably in better shape than people think it is.
And Warwick, you are nodding there. Do you concur?
Yeah, I mean, I've always found that property market very important. It's playing ball. Rents are higher. Banks are starting to lend into the home space because you can get buy to let again. So that's very positive.